The Foord General Equity Fund has outperformed its benchmark, the all-share index, by an average of 3.2% per annum since inception in September 2002. The fund's top 5 stock picks currently account for 30% of the portfolio and include an unlikely candidate, that being Standard Bank. Joining us from Cape Town to tell us what else the fund has been buying and selling is Mike Soekoe. Thanks so much for your time, Mike. Well, let's start with Standard Bank. Obviously, you believe, or Foord believes, that the prospects for the bank with a big African exposure are very positive.
Yes, exactly, Bronwyn. Thanks for having me. Thanks, Warren. What we always try and do at Foord, though, is we've got 2 banks in our portfolio. We've got Standard Bank and RMB, and we've got our retail stocks. So that's going to work really well if the rand stays strong, like it's done over the last 3 years. In this low interest rate environment, the consumer is quite strong. So those are stocks that we like for that scenario. And then, as you'll see on the other stocks we've got in the portfolio, we've got our rand hedges and we've got our commodity rand hedges in case the rand weakens. So it's always just trying to get that balance right. But we do like banks and the retailers. We think we still think the consumer's in a good place, and hopefully they will, as the year progresses and next year comes in, the property market will start picking up. That'll help the banks. So we're still positive on banks.
Mike, you have said the dirty word on the show, and that is retailers, because most of the fund managers we speak to are out of retailers, and they haven't held retailers for quite a while. Tell us about some of the retailers you're holding, and also why you're holding them. Is this consumer story holding up, and is it expected to do so going forward?
You know, Warren, it was quite interesting. When we did our strategy sessions about 4 years ago, we had a look at the one area in the South African economy where we thought where a good theme would be, and that was consumers. The government are giving above inflation increases. You get 13 million people now that get social grants. Interest rates were low. And it was the one area that we felt fairly confident in this country to invest in. What I think a lot of people might have also overlooked is that Edgar's got taken out in a private equity deal. So, of course, what happens often with that, it's done with a lot of debt. And often they can't reinvest in that business. And remember, Edgar's was the gorilla in the clothing industry in South Africa. So we were thinking that probably the Truworths and the Mr. Prices and the Forshinis would gain some market share from that. So I know some of the other asset managers looked at the PEs and said at 20 PE it's far too expensive. We didn't just look at that. We didn't just look at the valuation. We tried to look forward 2 or 3 years and said, what is going to be the drivers of these business? And what we do like about retailers, they've got fantastic management, they're on very good forward dividend yields, they've got strong balance sheets, good cash flow. So it's just the type of companies we like. So we've stuck with our retailers, and they've done fantastically well for us. And we will still stick with them, even though they are getting expensive now. But you know what's quite interesting? I heard you speaking to Steve earlier, and he was talking about the Anglo valuation. And if you look at Truworths, currently they're on a 19 PE, Anglos are on a 10 PE. But if we look 12 months forward and on current commodity prices and the rand staying where it is, Anglo will suddenly be on about an 18 PE. And Truworths, because the earnings is growing at 15% per annum, is going to probably be on about a 16 PE. So in 12 months' time, things can change very quickly. So we're still happy to stay with our retailers. We still like them. And also what it does in our portfolios is it balances the portfolio.
Well, Mike, you mentioned that you like the retailers, but I just want to indicate for our audience that you love the diversified miners, BHP and Anglo American. Your biggest exposure in your top 5 stocks being to BHP, Billiton, followed closely by Anglo American. So that just puts it in perspective for our viewers this evening. You obviously believe in the resource cycle and that China is going to come out like a shining knight.
We do, Bronwyn. Again, it's that balance. So we haven't got precious metals in our portfolio. We certainly won't have gold shares. We don't see any certainty in earnings on a 3 to 5 year view there. Their costs go up by 10 to 15% per annum. And we can't see that rand gold price going up by that amount year after year. So to us, gold shares don't make any investment sense on a long-term view. Platinums, we've got a very small amount of platinum. So most of our commodity holdings is in Anglos and Billiton. We've got some small Kumba iron ore and some Sasol in there as well. But again, it's trying to find that balance, because as I was saying, none of us know what the future is going to be. The rand could stay strong like it's done over the last 3 years. You know, in 2009 the rand was 850, and now we're in 2012 and it's 850 or 870. So, you know, we can't read it. No one can read the future. So it's best to just try and have a balance in a portfolio. If the rand stays strong, you've got your retailers and banks. The rand weakens, you've got your SABs and your Richmonds and your Billiton and your Anglos, and just try and keep that balance.
Mike, you alluded to, we've spoken about Standard Bank, but you alluded to holding RMB holdings as well in your portfolio. I wanted to ask what other financial services companies you guys might have been buying recently, specifically with reference to some of the insurance companies like Santam and some of the other ones there. So do those come into the horizon and the portfolio, and if not, why not?
You know, we haven't really been big fans of the insurance sector. We think that business model is maybe a little bit outdated. As you see Alan Gray and Coronation getting into the retirement side of business, offering RAs and retirement products, we think more people are going to go into that direction. So we haven't really, so our holding in financials is just really in Standard Bank and RMB. We've got a small holding in Coronation, which we've had for a long time. And we've also got a small holding in Discovery on the health side of things. But that's really all we've got. We haven't got any other insurance companies in there.
I want to bring us to Sasol, which also is in the top 5 equity holdings within your equity portfolio. Are you, like many other fund managers, waiting for the foreign investment community to take a liking to Sasol, to cause a re-rating in the stock, and then you benefit from it? Or is there another rationale for holding Sasol at the moment?
For us, it's just a little bit of protection. As I say, we haven't got golds or platinums really. So, and we do tilt our portfolio, we do think the rand should weaken. So Sasol really benefits from a weaker rand. The industry though is changing, and we are worried about the shale gas deposits that are being found in the US. There's big talk, as you've seen, by the International Energy Agency that came out saying that the US will be basically self-sufficient in oil by, I think it was 2025. So that is going to probably put a lid on oil prices maybe going forward. But we've got it there almost as an insurance in case that rand weakens.
Just talking about some of the other holdings, and I like to get into the industrials because no one really talks about them. It seems that many fund managers are infatuated with the resource counters and the retailers. You've got quite a big holding in the industrials at this point in the fund, Mike, and I'd like you to just expand on some of the choices within that sector.
Look, we like things like Bidvest. We've got Hudeco, Invicta. Those kind of companies we really like. We had some Astral Foods, but we're a little bit worried about the industry. All the imports that seem to be coming in from Brazil, we don't know if it's maybe a game changer in that chicken industry. So we've actually haven't bought any more. We just had started buying and we've stopped there. But generally we like the industrials, the good quality industrials. Again, you know, what we find in there's not that much good management out there. And we've got very concentrated portfolios. We try and have no more than 30 shares in that equity fund. And if we like management and they've got strong balance sheets and good outlooks for it on a 3-year view, we're quite happy to have those. So the Invictas, the Hudecos, we've got Remgro in there, Bidvest. We've got Aspen. We've really liked Aspen for a long time, which we've held for a long time. And then we've got our rand hedges, like our SABs and our Richmonds.
So at this stage, just on that SAB note, I mean, that's one of the other companies that have enjoyed a great run in their share price. You still see value in holding those shares, even though they've had such a strong run, and they might be, by some accounts, quite expensive.
Warren, you're quite right. That's a very good point, because what is happening at the moment, and I think this is where Foord has actually been fortunate that our performance has really done well, is that we do buy these quality shares. So we were already in those shares already 3 years ago. It's become almost a global norm at the moment to try and buy these good quality shares. Like our retailers, you've noticed how the foreigners have come in buying our retailers because they want some certainty in income stream. and they like the businesses. So you have seen that theme, and we've actually ridden that because that's the kind of companies we always hold. If the global economy does recover next year and there is a switch back into more growth-orientated companies, we are maybe a little more bullish on the global economy. We do think China is going to have the soft landing. We actually think it's turned already. We're quite positive about the US if they can just push this fiscal cliff away. And so we think that there will be an uptick. Then you're quite right. Those valuations on those stocks are too high and they will come lower. But for us at this stage, we're still happy to stay there. It gives us our balance, and hopefully we can move out of them when the right timing is right.
Is the Africa story working its way into your portfolio? You look at Standard Bank, obviously that stock commands a high rating because of its Africa exposure and the potential on that front. Is that a big theme as far as you're concerned?
I'm afraid not, Bronwyn. It's not really somewhere where we're looking. So, hopefully a Mr. Price will get in, go through Africa or a ShopRite, but it's not really where we're looking. We still think the South African market's okay. We like the developed markets. We think that their valuations are cheap there, and that's where we would be looking. But Africa, not particularly.
And Mike, before we go, a semantics issue. I always go to pains to say Foord. I hear that you are saying Foord. Do you go Foord or Foord going forward?
It's Foord, and we go. Hopefully, we'll go forward and keep looking forward into the future.